My name is Ethan Trombley, and I am from Bowling Green State University. I would say that the most important lesson I learned in the research challenge is just how to collaborate with a group of people to form an analysis. A lot of times at school when you're performing an analysis on a stock, you're doing it individually, but to come together as a group and to pretty much all come to the same opinion, it takes a lot of work and a lot of extensive research. So I think that was the best thing I take away, just the collaborative skills that I've gained from this process. Well, I think the biggest challenge was really just the timing of it all. The elements weren't really in support of us when we were a few weeks away from the due date. We had some weather scares. Our team was scattered pretty much amongst the world. We have one teammate from Brazil. We got others separated in different states. So I think the biggest challenge was just finally be able to reunite in Bowling Green to bring it all together to make a final deliverable. I definitely think so, because I think it just shows that no matter where you are, the work has to get done, and I'm sure that's something faced by equity analysts anywhere, because I'm sure that they're not always at the office. They could be doing their work anywhere, as many hours as they work a week. So that's what, yeah, I think it definitely reflected it. I think it'll definitely make me more analytical. And I think it's definitely something that I could easily bring up to an employer, because it's something I'll definitely be proud of in the future. I think that now, like doing this after taking an investment class, it just only goes to improve my ability for stock analysis and the rest of my group members. So I think going forward, I think we all have a little bit more interest in the profession of being a security analyst.
My name is Ethan Trombley.
I'm Evan Vokey.
I'm Josh Tickle.
And I'm Francisco Coleman.
And we're from Bowling Green State University.
All right. So based on our analysis, our evaluation models, and our estimates, we estimated the Kellogg stock value at $49. Therefore, comparing to current price levels, we recommend to sell the stock. These are some of the highlights of our research. We'll explain throughout the presentation. Some of the major ones include the competitive industry and the substantial amount of debt that the company currently has. Here below here, we have a graph that compares our intrinsic value to the historical price of the company in the last 5 years. Next, I want to talk a little bit about the company. It was founded in 1906 by William Kellogg. It is headquartered in Michigan, and it operates in over 180 countries. The company has over 30,000 employees, and it's the world's leading breakfast cereal manufacturer. Some of the main products include cookies, crackers, veggie foods, and cereals. And some of the well-known brands that the company has are Apple Jacks, Pringles, Pop-Tarts, and Fruit Loops. All right, so here we have a revenue breakdown by segment. Kind of compares the numbers from 2009 to 2012. As you can see, U.S. morning foods represents their major source of income. However, this segment specifically has been struggling because of the U.S. oversaturated market, especially the cereal category. And it grew by only 3% in this period. You also have U.S. snacks, which is another major source of income for them. We believe this growth was mainly through mergers and acquisitions. We have Pringles in 2012. Was a big player. And as you can see, Asia Pacific and Latin America still represent a small percentage of the company's total revenue, about 7 to 8% each. However, these regions, specifically Asia Pacific, are growing much faster than most developed regions. I believe Asia Pacific grew by 36% in this period. So the company is really struggling to maintain its market share on its main segment, the cereals category specifically, and it's really betting on emerging market growth to compensate for it.
Okay,
So Kellogg's operates in the packaged food industry, and this industry is very competitive. And when we did our analysis, we chose three companies to compare Kellogg's to. And the three companies we chose were Kraft, ConAgra Foods, and General Mills. And in the middle is just a graph of prior year sales, just to get an idea of what the industry's like and where all four of these companies are in terms of sales. But yeah, like I said, it's just a very competitive industry. And we decided to do a ratio analysis on the four companies to kind of get an idea of where they stood. In the first analysis ratios we looked at were profitability ratios. And as you can see, Kellogg's has some concerns as all five profitability ratios have decreased from the 2010 numbers. So we found a significant concern operating profit margin, which decreased by 5 percentage points from 2010. Another concern is ROE, which has decreased by 20 percentage points from 2010, and that was largely driven by decreased net income over the past few years. Moving down to long-term solvency, another concern we found with Kellogg's was their very high debt ratio. In comparison, other than Kraft, also has a high debt ratio. But we found a very close competitor in General Mills, and they have a 20% lower debt ratio than Kellogg's currently does. Moving on to liquidity, we also found some concern with the current ratio with Kellogg's, as it was at 0.7 in 2012. And this may signify that Kellogg's would be unable to pay off short-term obligations if they came due today, whereas their three competitors are at 1 or above. So that just kind of a tough position for Kellogg's to be in. Moving down to efficiency, day sales outstanding for Kellogg's was a little high in comparison to the three competitors, but overall they're pretty much comparable in every other category we looked at for efficiency. And we also did a DuPont analysis, which was driven largely by, it shows how ROE is driven largely by operating margin, asset efficiency, and financial leverage. The equity multiplier has increased as the companies relying more on debt to finance their assets. And as we already mentioned, the ROE and total asset turnovers remained relatively same. Return on sales has decreased, which also raises concerns there might be some financial issues looming for Kellogg's, and they may be losing out on some of their market share.
Next, we're going to talk about Kellogg's strategy. Over the next few years, management expects sales to increase by 3 to 4%, and they also hope to see EPS growth of 7 to 9%. On May 31st, 2012, Kellogg's acquired Pringles for $2.7 billion. They had to take out $2 billion of long-term debt to fund this acquisition, adding to what was at the time $5 billion of long-term debt. In response to recent customer trends, Kellogg's is rolling out new product lines focused on frozen breakfast sandwiches and on-the-go breakfast shakes. Project K is Kellogg's new 5-year cost savings plan. Back in early 2009, Kellogg's did unveil a cost savings plan called Project K Lean, which was considered by many analysts to be a disappointment. So while both projects are obviously not similar, there is some uncertainty with Project K based off just past history with those cost saving initiatives. And going forward, Kellogg's growth strategy is going to be heavily focused on emerging markets. For our valuation, we calculated a required return on equity of 7.54%. We took the average of 3 models, those 3 models being the capital asset pricing model, the dividend valuation model, and the bond yield plus risk premium model. For the CAP-M model, we used a risk-free rate of 3%, which is the 10-year yield, is a yield on 10-year Treasury notes. We used a market risk premium of 6.5%, which is the average return on large stocks from 1926 to 2009, so it's a very long-term view on it. For the dividend valuation model, we used a growth rate of 4%, which we calculated from a 5-year geometric mean of the last 5 annual dividends that Kellogg's has paid out to their shareholders. For bond yield plus risk premium, we used a bond yield of 4.99%, which is the yield on Kellogg's bonds that mature in 2031, and we used a equity risk premium of 3.5%. You'll see here that that's not what's on the screen. That was just due to pulling the wrong screenshot from Excel, but we used 3.5% based off the rule of thumb adding 3 to 5. We believe that Kellogg's is investment grade, but has inherent risk. First model we used was the dividend discount model. We had forecasted EPS growing at a growth rate of 3.5%, which we calculated once we ran regression with forecasted GDP. We calculated an intrinsic value of $50.47. Our next model was the residual income model. We used a growth rate of 1%, We did this because when we forecasted out our residual income per share, we saw no growth, so we went with a conservative growth rate of 1%. We calculated an intrinsic value of $53.30.
The last model we used was company multiples approach. The competitors that we used, once again, were ConAgra Foods, General Mills, and Kraft. These were the ratios that we used. We weighted the industry average 50% as well as comparable competitors. 50% comparable competitor includes General Mills, ConAgra, and Kraft, while industry average also includes Kellogg. Looking at the ratios, currently we feel they are overextended and they would more likely be in line with their competitors and the industry average. After completing this model, we found an intrinsic value of $42.01. So our valuation summary, we weighted the dividend discount model 40%, the residual income model 30%, and the company multiples 30%, which yielded us a final target price of $49. Some of the risks involved with investing in Kellogg is they are in an extremely competitive industry. Companies like General Mills have set aside numerous resources towards research and development as well as different marketing campaigns. Kellogg's has a substantial amount of debt, around $7.9 billion long-term debt. They also have a capital structure of around 80% debt. They're also subject to product liabilities, as has been seen recently with Pringles recall as well as Mini Wheats recall. In conclusion, while we feel that Kellogg's has a strong brand and a consistent dividend, they are in a very heavily competitive industry. They have extremely high levels of debt, and that we don't foresee future sales growth within this company. Thank you.
And we are open to any questions at this time.
So you got to sell on this thing. What's the catalyst that's going to get this thing to go down to $42 or whatever your price target is?
Does you want to take it?
We believe it to just be based off the fact that they're mainly dependent on the cereal market in the U.S. cereal market, and while they are trying to branch out with new product lines and trying to make their way out to emerging markets, I feel as though since the industry is so oversaturated that there's just no potential for sales growth there, and we think that people are more and more going to realize that the stock is overvalued, which will drive the price down.
And as I mentioned before, the company is really struggling to maintain the market share on the cereal category, which I showed was the major source of income. So they're also like really betting on emerging markets growth and really emphasize their presence there to kind of compensate for that. And really recently you've seen all the turmoil going on in emerging markets, and they've been showing slower GDP growth. Brazil has been really slow lately, and therefore, I mean, they're betting on those markets, but they're not really showing much potential in the near future. So we really don't think that their strategy is really aligned to compensate for their slower market share on the cereals.
And we also kind of, when we looked at the snacks market, U.S. snacks market, the acquisition of Pringles was big for them, but we think that Pringles is kind of underperformed in comparison to competitors such as Frito-Lay. So I think that was another factor into it.
And once again, like looking at the ratios where they are right now compared to where they have historically been, we believe that they will eventually revert back to where they have historically been and not be so extended.
When you say historically been, you mean?
Like the 5-year, like this is our 5-year average of the P or the ratios versus what they are right now.
In the assumption of that 3 to 4% sales growth, so that mostly is that, what part of that is organic? Is it mostly acquisition? Is there a way they're going to grow here on out?
Well, in recent years, sales growth with Kellogg's has actually mostly been seen through M&A, mergers and acquisitions, and actual price hikes, and not so much through growth in unit sales. So when Kellogg's is predicting 3 to 4% in sales growth, I think that that's what they're focusing on now. Hopefully, bringing more sales in from the acquisitions and possible price hikes as opposed to unit growth, which is what we're concerned about.
Can you comment just regarding the 2009, when it was a Project K lean, was not as successful, did not bear fruit. Is it the same management team that's put together Project K, the current cost-cutting project?
I'm unsure if it's the same management team that is running it, but I do know that they are doing things a little differently than they did with Project K-Lean, whereas Project K is much more focused on supply chain improvements than Project K-Lean was, I believe.
What was the focus of Project K-Lean?
I think Project K-Lean was just mostly focused on reducing production in manufacturing facilities where they didn't see high demand of the products that they were making there. Whereas Project K is focused on that, but they're also focused on the improved supply chain and also expanding into emerging markets.
Does the company have a history of pricing power where they can implement price increases if there's commodity price increases? Or is it gains by changing packaging? What's the history of that?
I think they somewhat have, but I think that was more in the past. Because when we looked at it about 15 years ago, before Kellogg's acquired the cookie company Keebler, about 80% of their sales was made up of the cereal market, and obviously that's changed within a 15-year span. So I think they used to have some of that, but going forward, like General Mills is becoming a close number 2 in the cereal market, and obviously I think that's why they made the acquisition of Pringles. But so I'm not sure. I don't see it as being a big a factor going forward for Kellogg's.
And going off that, the company has really benefited from commodity prices lately. Corn and soybeans have really declined in prices lately. But we see that that trend could reverse. You know, we had that draw in 2012 that could happen, you know, next summer, and that could bring prices up again, which would definitely decrease their margins.
Do they hedge commodity prices or foreign exchange?
I believe so.
Yes,
Yes.
based off the presentation that they gave us, and that was a specific question asked, they definitely do hedge.
How did you come up with your weightings on this ratio analysis here?
Well, we went with 3 words, or are you referring to the comparables?
Well,
Or-
yeah.
Right,
Yes,
with
my
the
graph
Oh,
here.
okay, you weren't. Sorry about that. Josh, would you want to take that one?
We just felt that they should be more in line with their competitors. So, with the price to earnings, looking at 15, looking at their comparable competitor average, so we felt they should be in line with
Yeah,
those,
we-
kind of weighted
Well,
them
I
based.
guess to rephrase my question, you've got a 35% weighting on PEs, 15% weighting on price to book, 35% weighting on price to sales, 15% on price to cash flow. To me, if they've historically traded more on a price to sales basis and their valuation is $77, I'm much less inclined to short this stock with your sell rating than if they've historically traded on a price to book basis, and I could expect them to head down toward 34. So how'd you come up with the weightings?
Basically, when we look at it, we saw that PE ratios and the price to sales ratios, they were very close to their competitors, and we saw that the multiples were also close, and then that's made us think that those are more realistic ratios to weight it more on this analysis. So the price to book and price to cash flow, there's a big difference of Kellogg and the competitors. So we really don't think on those ratios they can be compared to the competitors specifically.
How about historically? And did you look at it on a historical basis?
I mean, we took the 5-year average at the bottom there for just Kellogg's of the ratios.
But at this time, we don't have the 5-year average of the competitors' ratios.
Okay, so on a 5-year average, even if you just look at the 5-year average, they're pretty much, looks like they're pretty much in line on a PE basis. They're probably a little overvalued on price of sales,
Well,
overvalued on price to cash flow, and you know, maybe a little undervalued on price to book. So
the numbers above, they're 2012 numbers. The current numbers are actually down there. So at PE for Kellogg is 21, which is above their 5-year average. That's why we think that in the near future, you know, that tend to come down.
So if they have 3 to 4% revenue growth, and you get to 7 to 9% earnings growth by efficient, you know, how do you get to that number? How are earnings going to grow at a faster rate than revenues based upon what you're seeing with this company today?
I think it has a lot to do with the cost cutting. As it's been reported in the news recently, Kellogg's has cut over 2,000 jobs. They're looking to cut
closed manufacturing facilities in North America, and I think that's what's going to drive the after-tax earnings.
And also, they've been doing stock buybacks. So if you look on that 7 to 9% earnings per share growth as they buy more stock buybacks, that will.
You had the opportunity to visit the company, meet with management. What was your feeling about the quality of management?
I personally felt that they did have a good management team and that it is a good, stable company. It's just, we just couldn't see enough possibility for growth. But I mean, as a company as a whole, we had no problem with the company. We think it's a good company.
How much stock does the Kellogg Foundation own?
That was pretty high. That was close to 20 to 25%, wasn't it?
I think Kellogg, the foundation, actually sold quite a bit of their shares towards the end of 2013.
I think it's in their trust they have to sell shares though.
I'm just wondering, because if you've got to sell on it, I'm assuming if they're not selling, or are they selling, or, because that will play into, whether or not the stock is going to be more volatile or less volatile.
I think they're required to, it's in their, I don't know what to call it, but I think they're required to sell like every so often. That's what I read.
Did you see any of the competitors as being a better investment? Yeah, comparison.
Well, as you can see from the prior year's sales, Kraft has a substantially more amount of sales compared to the other three competitors in the industry. General Mills, like we mentioned, is becoming a close number 2 in the cereal market, but we don't see much growth in the United States in the cereal market.
One thing that General Mills is really, in my opinion, is doing well. It's really adapting their product lines to consumer trends, especially the gluten-free consumer trend going on. I believe a third of Americans are kind of following that diet. So General Mills is more in line adapting their products to.
Thank you.
Thank you.
Thank you, guys.